It's the spring of 2005. A young couple sits across from a mortgage broker after months of searching for a home. They've done everything they were told to do. They saved for a down payment. They stayed employed. They paid their bills on time. Now they're finally holding the keys to what they hope will become the place where they'll raise their children. The broker smiles warmly and slides a stack of papers across the desk. He explains that this loan is their best opportunity to become homeowners. The monthly payment looks affordable. The paperwork is thick, the language is complicated, and the closing appointment has already taken hours. Like millions of Americans before them, they sign where they're told. They leave believing everyone in that room wanted the same thing they did, a successful home purchase. What they never see is the compensation agreement sitting behind the scenes. It doesn't describe their monthly payment. It doesn't explain the risks of the loan. It explains how much extra money the broker earns if the family accepts a mortgage with a higher interest rate than the lender was willing to offer. The more expensive the loan, the bigger the commission. To the family, it looked like professional advice. To the broker, it could also mean a larger paycheck. This wasn't necessarily hidden in the sense of being illegal. In many cases, the compensation was disclosed somewhere within pages of complex closing documents. But few borrowers understood how broker incentives worked, and many believed the broker was acting primarily in their interest rather than being compensated by the lender. For years, this system quietly rewarded the sale of more profitable loans. Not necessarily better loans, more profitable ones. When housing prices kept climbing, almost nobody noticed. As long as home values rose, the cracks remained hidden beneath the surface. Then the market stopped rising. Monthly payments began to change. Families who thought they had purchased stability discovered they had purchased uncertainty. Savings disappeared. Foreclosure notices appeared. Entire neighborhoods changed almost overnight. By the time the world called it the financial crisis, millions of people were already living through it. Most explanations blame reckless borrowers. Others blame greedy banks. Both contain some truth, but they leave out one of the most important pieces of the story. A system where ordinary people often trusted advice from professionals whose financial incentives weren't always aligned with their own. Understanding that system changes the way you see not only the housing crash, but almost every major financial product sold today. Because this story isn't really about mortgages, it's about incentives. And incentives have a way of changing behavior long before anyone notices the consequences. To understand how this happened, we have to go back to a time when buying a home felt almost risk-free. During the late 1990s and the first half of the 2000s, home prices climbed steadily across much of the United States. News headlines celebrated record sales. Television programs flipped houses for enormous profits. Dinner conversations shifted from asking whether someone should buy a home to wondering why they hadn't bought one already. Owning real estate increasingly looked less like a long-term commitment and more like the safest investment an ordinary family could make. Banks wanted to make more mortgages. Mortgage companies wanted to approve more borrowers. Investors wanted more mortgage-backed securities to buy. Everyone along the chain benefited when another loan was created. That demand changed the business itself. Years earlier, a local bank might approve a mortgage and keep it for the next 30 years. If the borrower couldn't repay the loan, the bank suffered the loss. That gave lenders a powerful reason to be careful about who received credit. But over time, something changed. Increasingly, mortgages were bundled together and sold to investors as securities. Once a lender sold the loan, much of the long-term risk shifted away from the original lender and toward investors who purchased those mortgage-backed investments. Faster new mortgages could be originated, the faster new securities could be created, and the faster everyone involved earned fees. Imagine an assembly line. Instead of building cars, it produced mortgages. At one end stood families hoping to buy homes. At the other end stood pension funds, insurance companies, and investors searching for returns. Between them stood mortgage brokers, lenders, investment banks, credit rating agencies, and countless financial professionals. Each earned money when another loan moved down the line. Few earned more money by slowing the process down. That distinction mattered, because once speed becomes profitable, careful judgment often becomes expensive. Mortgage brokers occupied one of the most influential positions in this system. For many buyers, the broker wasn't just someone processing paperwork. They were the expert, the guide, the person who supposedly knew which loan was best. Borrowers often believed a broker could search among many lenders and recommend the most suitable option. Sometimes they did. Many brokers acted responsibly and helped families secure appropriate mortgages. But the industry's compensation structure also created opportunities for abuse. One practice attracted particular attention after the housing collapse. If a borrower accepted a mortgage with an interest rate above the lender's minimum approved rate, the lender could pay the broker additional compensation, commonly known as a yield spread premium. While these payments were legal at the time and could sometimes offset borrowers' upfront closing costs, investigations found they also created incentives to steer some borrowers into higher-cost loans than they might otherwise have qualified for. That sounds technical. Its effect was anything but. Imagine shopping for a car. The salesperson tells you the cheapest available model costs $25,000. What they don't mention is that another dealership had already approved you for the exact same car at $22,000. The more you overpay, the more they earn. Now imagine making that decision not on a car, but on a 30-year mortgage. A slightly higher interest rate doesn't just cost a little more. Across decades, it can mean tens of thousands of dollars in additional payments. Sometimes much more. Most borrowers never calculated those lifetime costs while sitting at the closing table. They focused on one number, the monthly payment. And as long as that payment looked manageable, everything seemed fine. For a while, it often was. That apparent affordability became one of the most powerful illusions of the housing boom, because many of the loans being written weren't designed to stay the same. Some were built to change later, much later. And by the time those changes arrived, millions of families would discover that the mortgage they believed they understood was never the mortgage they were actually living with. That is where the story truly begins. The mortgage looked ordinary. The payment fit the family's budget. The broker congratulated them on becoming homeowners. Life moved on. For the first year, nothing seemed wrong. The mortgage payment arrived each month and they paid it just as they had planned. Friends were buying homes too. Neighborhoods were growing. Property values continued climbing, making many homeowners feel wealthier simply because their houses were worth more than when they bought them. Rising home prices created a sense that even if something went wrong, the house itself would provide a safety net. That confidence wasn't limited to homeowners. It spread through nearly every part of the financial system. Mortgage lenders believed rising home prices reduced their risk. Investors believed housing markets across the country wouldn't decline all at once. Credit rating agencies gave many mortgage-backed securities high ratings based on models that assumed widespread nationwide declines in home prices were extremely unlikely. Everyone was looking at the same numbers. Almost nobody was asking what would happen if those numbers stopped moving upward. The entire system depended on one quiet assumption: tomorrow's home prices would be higher than today's. As long as that remained true, problems could often be postponed. A homeowner struggling with payments might refinance. Someone with little equity today could have enough equity next year. Lenders could issue new loans to replace old ones. Investors continued receiving payments. The machine kept moving. But underneath that optimism, many mortgages were built very differently from the traditional 30-year fixed-rate loans most people imagine when they think about buying a house. Some loans carried low introductory interest rates that lasted only a limited period before adjusting upward. Others required little or no documentation of income compared with traditional underwriting standards. Some allowed borrowers to make unusually low initial payments. These products were not inherently fraudulent, and in certain situations they could serve legitimate financial needs. The problem arose when borrowers did not fully understand the risks or were steered into products that were poorly suited to their circumstances. Imagine signing a contract for a gym membership. For the first 6 months, you paid $20 a month. Then, without changing anything about your routine, the price automatically jumps to $60. You can still afford it if your income has increased. If it hasn't, the membership suddenly feels very different. Now replace that gym membership with the largest financial commitment most families will ever make. The monthly payment wasn't always permanent. Sometimes it was an introduction, and introductions are designed to make people comfortable. This is why focusing only on the initial monthly payment can be so misleading. Many borrowers naturally asked one simple question: can I afford this payment? A more important question often went unasked: will I still be able to afford this payment if the terms change? For many families, no one slowed the conversation down long enough to make that distinction clear. Closing appointments were often fast-paced. Documents stretched into hundreds of pages. Financial terminology felt unfamiliar. Borrowers relied on professionals to explain what mattered. And professionals were operating inside a system that rewarded completed loans far more than careful education. Again, that doesn't mean every broker acted irresponsibly. Many didn't. Many warned their clients. Many refused to recommend loans they believed were unsuitable. But a financial system doesn't require every participant to behave badly to produce bad outcomes. It only requires enough incentives pointing in the wrong direction. Imagine 10 salespeople working in the same office. 9 recommend products honestly. One consistently pushes the most expensive option because that's where the biggest commission is. Over time, that single person's decisions affect hundreds of families. Now imagine thousands of offices across the country. The scale changes everything. By the middle of the housing boom, mortgage lending had become one of the fastest-growing businesses in America. Competition intensified. Companies searched for ways to approve more borrowers. Loan products became increasingly creative. Credit standards loosened in parts of the market. Not everywhere, not all at once, but enough to expand lending dramatically. At the same time, Wall Street's appetite for mortgage-backed securities remained enormous. Investment banks purchased mortgages from lenders, pooled thousands of loans together, and created securities that could be sold to investors around the world. Pension funds, insurance companies, mutual funds, and other institutional investors bought these investments because they appeared to offer attractive returns with relatively low risk, especially when supported by high credit ratings. Think about what that meant. The family sitting at a kitchen table in Ohio, the retired teacher whose pension invested in mortgage securities, the investment bank in New York packaging those loans. They were all connected. Most of them never realized it. The mortgage signed in one neighborhood became part of an investment portfolio on the other side of the country, or even the other side of the world. Risk wasn't disappearing. It was being redistributed, and every transfer made the system more difficult for ordinary people to understand. The person making the monthly payment couldn't see the investors. The investors couldn't meet the homeowners. Each trusted someone else to evaluate the risk. Borrowers trusted brokers. Investors trusted credit ratings. Banks trusted housing prices. Everyone trusted the next link in the chain. Few people stepped back to ask whether the chain itself had become too fragile. Then something subtle happened. Home prices stopped climbing as quickly. Not crashing, just slowing. For years, rising prices had hidden weaknesses in the system. Once that upward momentum faded, those weaknesses became impossible to ignore. Loans that depended on refinancing became harder to refinance. Adjustable rate mortgages began reaching the point where their introductory rates expired. Monthly payments increased. Families who had carefully budgeted around one payment suddenly faced another. Some managed the increase. Many did not. The illusion that had powered the housing boom began to crack. And when enough families encountered the same problem at the same time, it became clear that this wasn't simply a series of individual mistakes. It was the consequence of a financial system in which millions of decisions had been shaped by the same powerful incentive: keep the loans moving. Because once the assembly line slowed down, everyone would discover just how much had been built on the assumption that it never would. For a while, the warning signs were easy to ignore. A family misses one payment. Another refinances at the last minute. A lender forecloses on a single home. Individually, these looked like ordinary financial setbacks. Collectively, they became something much larger. As introductory interest rates expired, many homeowners saw their monthly mortgage payments increase. At the same time, home prices in many markets stopped rising and, in numerous areas, began to fall. Families who had expected to refinance into a new loan often discovered they no longer qualified, or that their homes were worth less than the balance they still owed. For years, homeowners had been told that real estate almost always appreciated over time. That belief had shaped countless financial decisions. It encouraged people to stretch their budgets. It reassured lenders. It comforted investors. But when home values declined, that confidence disappeared almost overnight. Imagine buying a home for $300,000 with a mortgage of $285,000. A few years later, the home is worth only $240,000. You still owe far more than the house can be sold for. Even if you want to leave, you can't without taking a substantial financial loss. You are, in effect, trapped. For many families, the mortgage payment itself wasn't the only problem. Medical emergencies happened. Jobs were lost. Businesses closed. Divorces occurred. Life continued exactly as it always had. The difference was that homeowners no longer had the financial flexibility they thought they possessed. Miss one payment, then another. Late fees accumulate. Collection notices arrive. Eventually, foreclosure becomes a possibility. For some families, it became a reality. Between 2007 and 2010, millions of foreclosure filings were recorded across the United States, affecting households, neighborhoods, and local economies. Vacant homes reduced nearby property values, strained municipal budgets, and accelerated declines in communities already under financial pressure. The damage extended far beyond the people who signed the mortgages. Construction workers lost jobs, small businesses lost customers, retirement funds holding mortgage-related investments suffered losses, banks faced mounting write-downs. Credit markets tightened. The problems that began around individual kitchen tables spread through the global financial system. In 2008, several major financial institutions either failed, were acquired under distress, or required extraordinary government support as confidence in mortgage-related assets collapsed. What had begun as weakness in one segment of the housing market became the most severe global financial crisis since the Great Depression. The tragedy wasn't that every borrower had made a reckless decision, nor was it that every lender had acted dishonestly. It was that millions of ordinary decisions were influenced by a system that often rewarded volume over long-term outcomes. When enough people respond to the same incentives, small mistakes become systemic failures. The crisis forced policymakers to ask difficult questions. How could a financial product this important become so difficult for ordinary people to understand? Why were incentives encouraging some professionals to prioritize larger loans over better loans? And how could the mortgage market be made more resilient? In the years that followed, significant reforms were introduced. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 created new consumer protections and established the Consumer Financial Protection Bureau, an agency responsible for overseeing many consumer financial products. New mortgage rules required lenders to make a reasonable, good-faith determination that borrowers had the ability to repay their loans. Compensation rules also reduced practices that allowed mortgage originators to earn more simply by steering borrowers into loans with higher interest rates. Clearer disclosure requirements and the creation of qualified mortgages sought to reduce some of the riskiest lending practices that had become common before the crisis. No, financial incentives never disappear. They change. Markets evolve. New products emerge. Different risks replace old ones. The lesson of the housing crisis isn't that mortgages are dangerous. Millions of families responsibly purchase homes every year using mortgages that fit their financial circumstances. The lesson is that incentives matter. Whenever someone earns money by recommending a financial product, it is worth understanding exactly how that recommendation is being compensated. Advice isn't automatically bad because someone is paid, but payment structures influence behavior. That is true in finance, it is true in sales, and it is true in almost every industry. The housing crisis is often remembered through dramatic images. Families carrying boxes out of foreclosed homes, bank buildings surrounded by television cameras, stock markets in free fall. Those images capture the aftermath. But the real story began years earlier. It began quietly, across thousands of offices, one signature at a time, one commission at a time, one loan at a time. Most people who walked into those offices believed they were making one of the smartest financial decisions of their lives. Many were, some weren't. The difference often came down to information they never knew to ask for, and incentives they couldn't easily see. That is why understanding financial history matters, because history doesn't simply tell us what happened. It reveals the systems that quietly shape the choices we make today. The names of the products may change. The paperwork may look different. Technology may make the process faster, but incentives still influence decisions, and they always will. The more clearly you understand those incentives, the harder it becomes for anyone to sell you a deal that benefits them more than it benefits you. If you enjoyed this documentary and want to understand the hidden incentives behind pensions, credit cards, insurance, retirement accounts, and other financial systems that affect millions of people, because the most expensive financial decisions are often the ones that seem perfectly ordinary, until you discover the story hidden behind the paperwork. Subscribe and join us for the next episode.